The Iran shock is coming, and I think most people are looking at it in the wrong way. They are looking at the headlines, they are looking at the oil price, they are looking at the fear. But the real question is not whether there will be noise. There is always noise. The real question is whether your portfolio is built for the kind of environment that is now unfolding. When oil moves violently, the consequences do not stay inside the oil market. Oil is not just a commodity. Oil is an input into transportation, production, shipping, food, chemicals, logistics, and almost every physical part of the economy. When the price of that input rises, it moves through the system like pressure, moving through a pipe. At first, people say it is just an energy story. Then they discover it is an inflation story, then they discover it is a Federal Reserve story, then they discover it is a consumer story, then they discover it is an earnings story. And by the time they understand that chain, the market has usually already done the damage. That is why I want you to listen carefully. I do not want you to click anything. I do not want you to panic. I do not want you to buy something just because someone said it is going up. I want you to understand the machine. The machine is simple once you see it. Oil prices rise, production costs rise, transportation costs rise, companies face higher input costs, consumers face higher prices at the store. Inflation becomes harder to bring down. The Federal Reserve loses flexibility. If growth slows while inflation stays high, you begin to move toward the condition investors fear most, which is stagflation. Stagflation is difficult because it puts policymakers in a trap. If the economy weakens, the normal response is to cut rates. But if inflation is still hot, cutting rates can make inflation worse. So the Fed cannot easily rescue the market, and that creates the kind of environment where weak companies get exposed, weak balance sheets get punished, and weak investors make emotional decisions at the worst possible time. I have seen this pattern many times in different forms. The story always changes. The machine is usually the same. Sometimes the reason is war. Sometimes the reason is inflation. Sometimes the reason is a technology bubble. Sometimes the reason is a credit crisis. Sometimes the reason is a pandemic. Sometimes the reason is something that nobody had on their calendar, but the cycle itself repeats because human behavior repeats. People become confident at the top, they become fearful at the bottom, they overpay for comfort, they underpay for quality when fear is everywhere. Then later, they look back and call the opportunity obvious. It was not obvious when it mattered. That is the point. A crash by itself does not scare a prepared investor. A crash is a test. It separates people who own systems from people who own opinions. It separates people who have principles from people who have impulses. When everyone is frightened, the average investor wants certainty, but markets do not offer certainty. They offer probabilities, they offer prices, they offer moments. When a strong business is temporarily priced as though the world will never recover, that is where generational wealth is usually created, but only if you know what you are looking for. You cannot simply buy anything because it has fallen. That is not investing, that is hope with a trading account. You cannot simply buy oil because oil is rising. Oil is cyclical. Oil can rise sharply, then fall sharply. Oil can move from 60 to 100, from 100 to 140, from 140 back down again. That can create trades. But it is not the same thing as building a portfolio for the next decade. You cannot simply go to cash either. Cash feels safe in a crash, but over time, cash is eaten by inflation. The danger of cash is that it lets you feel comfortable while your purchasing power quietly disappears. You cannot build a durable portfolio by hiding in the defensive names everyone runs to during a panic. Utilities, telecom, healthcare, consumer staples, defense contractors, they can all have roles. But if your goal is to build wealth over 10 or 15 years, you have to think deeper than hiding from volatility. You have to ask a better question: which companies will become more important because of this chaos? Which companies solve problems that will become more urgent? Which companies have the balance sheets, margins, technology, and position to survive the storm and come out stronger? That is how I think about it. Not what will go up tomorrow, but what will the world need more of? Because the system is under stress. In a crisis, weak companies get weaker. Strong companies can become much stronger. Amazon is a useful example of the principle, not because you should blindly chase the next Amazon, but because the pattern is important. A great company can get crushed during a market collapse. It can look terrible on a chart. It can fall with everything else. But if the business survives, if the engine remains strong, if the market it serves continues to expand, the recovery can be extraordinary. Survival is the key word. A great company that survives a crash can become a wealth creator for years. A weak company that looks cheap during a crash can disappear. That is the difference most people miss. They see a falling price and think opportunity. I see a falling price and ask whether the system underneath the price is strong enough to endure. That is why I am not trying to chase oil for a few months. I am trying to build around the larger forces that the oil shock, the inflation shock, and the geopolitical shock are revealing. The first major force is reliable power. You cannot have the next wave of artificial intelligence without power. You cannot run data centers without power. You cannot scale advanced computing without power. You cannot run cooling systems without power. You cannot build the next technological cycle on an electrical grid that is already strained. AI is not only a software story, it is a physical infrastructure story. People like to talk about models, they like to talk about chips, they like to talk about apps. But behind all of that is electricity, cooling, data center construction, grid reliability, and the ability to deliver power where demand is exploding. That is why I care about energy, but not in the simple oil price way. I am interested in energy that compounds with technology. I am interested in companies tied to nuclear capacity cooling systems, on-site power production, and infrastructure that makes AI physically possible. In the source framework, 3 names were placed into that energy sleeve. CG was added in March 2025 and had moved higher from that point. VRT was added in June of the prior year and had moved much more sharply. Bloom Energy was added in February 2026 and had already moved meaningfully. The exact short-term performance is not the principle. The principle is that each of these businesses is connected to a bottleneck. One is tied to nuclear, one is tied to cooling, one is tied to on-site power production that is less dependent on the grid. That is the kind of thinking I prefer. I do not ask. What is exciting? I ask, where is the bottleneck? Because when the world needs something and there is not enough of it, the owners of that capacity can become very powerful. The second major force is memory. This is less dramatic to the public than artificial intelligence, but it can be just as important as AI becomes more advanced. The system needs more context. More context requires more memory, more agents, more complex workflows, more data moving through models, more reasoning steps, more storage, more retrieval, more high bandwidth memory. If the demand for AI capability rises tenfold, the demand for the supporting memory infrastructure does not stay flat. It rises with it, and the important part is that memory is not a market where new supply appears overnight. Production capacity takes time. Plants take time. Equipment takes time. Qualification takes time. Capital expenditure takes time. If the world suddenly needs much more high bandwidth memory, the companies already positioned in that market may have a window in which they are extremely important. There are only a small number of dominant players. The source framework pointed to Micron, SK Hynix, and Samsung as the group controlling most of the memory market. From a US-centric portfolio perspective, Micron becomes the clearest expression of that theme. The stock may move up or down in the short run. It may be down significantly from an earlier entry. That does not automatically invalidate the thesis. In investing, price pain and thesis failure are not always the same thing. A stock can fall while the long-term demand picture improves. A stock can rise while the underlying thesis gets weaker. That is why you have to think in terms of fundamentals, position, and system fit. Not simply the last price movement. Micron matters in this framework because of high bandwidth memory. That is the type of memory AI data centers need if the bottleneck is real. And if the company is positioned to address that bottleneck, then weakness can become an opportunity only if the business remains sound. That is the key condition. Weakness is only attractive when quality survives. The third major force is production. The AI cycle is not just about ideas. It is about making the machines, chips, tools, designs, and connections that allow the cycle to exist. NVIDIA and AMD are tied to the GPU side of the problem. ASML is tied to the lithography machines that make advanced semiconductor production possible. TSMC is tied to the actual manufacturing of many of the chips that power the system. ARM and Cadence are tied to design and software. AET is tied to connectivity. Each piece has a role in the production system. This matters even more during geopolitical disorder because the ability to produce critical technology becomes a strategic asset, not just a business asset. When supply chains are calm, people take production for granted. When supply chains become fragile, the companies that sit at critical control points become far more important. That is why I do not think of these businesses as random technology names. I think of them as parts of a machine. The question is not merely whether the stock is popular. The question is where the company sits in the machine. Does it control a bottleneck? Does it provide something difficult to replace? Does the world need more of what it does? Does it have margins that show strength? Does it have revenue trends that support the thesis? Does it become more important when the environment becomes more chaotic? That is how I sort through the noise. The fourth major force is decision-making in chaos. When the world is stable, many businesses can operate with ordinary tools. When the world is unstable, decision systems become more valuable. If supply chains are uncertain, if governments are changing rules, if geopolitical tensions are rising, if energy costs are volatile, if security threats are increasing, organizations need systems that help them see, decide, and act faster. That is the reason Palantir appears so often in this kind of framework. It is not just a software company in the ordinary sense. The thesis is that it helps institutions make decisions under complex conditions. Whether the market overpays or underpays for it at any given moment is a separate question. But the reason it belongs in the framework is that chaos increases the value of decision infrastructure. The same logic applies in a different way to CrowdStrike in cybersecurity. When the world becomes more digital and more unstable, security becomes more important, not less. Datadog and MongoDB fit into the visibility, database, and monitoring side. Oracle, Microsoft, Google, and Amazon fit into cloud and data infrastructure. These are not separate stories. They are all connected by the same underlying force. More digital complexity creates more need for infrastructure, security, monitoring, databases, and cloud capability. The public often sees these as stock tickers. I see them as functions. A portfolio should not just be a collection of names, it should be a collection of functions that match the world you believe is emerging. The fifth major force is automation and real-world productivity. In an environment with higher costs, geopolitical uncertainty, and pressure on margins, companies need to become more productive. They need to do more with less. They need to reduce waste. They need better logistics, better advertising, better data, better financial infrastructure, better robotics, better automation. This is where Tesla, Meta, Amazon, SoFi, and Robinhood appear in the framework. Tesla is tied to robotics and full self-driving. Meta is tied to advertising efficiency. Amazon is tied to AWS, retail data logistics, and infrastructure. SoFi is tied to digital financial services. Robinhood is added as another financial platform that could fit the productivity and financial technology sleeve. Again, the important thing is not to treat every one of these names as equal or to buy them without thinking. The important thing is to understand why they are in the conversation. They are tied to a world where productivity matters more. They are tied to a world where data matters more. They are tied to a world where the best digital platforms can expand, even when the macro environment is difficult. But having the right list is not enough. This is where many investors fail. They believe a good stock list is a strategy. It is not. A good list without a system can still destroy you because you can buy too much too quickly at the wrong time with the wrong expectations and sell when the system tests you. The system matters as much as the names. The system begins with gradual buying. I do not believe in pretending to know the bottom. Nobody knows the bottom. You can estimate value, you can study cycles, you can assess fear. You can study fundamentals, but you cannot know the exact low in advance. That is why a disciplined investor buys slowly. You build a plan before the fear arrives. You decide what you want to own, why you want to own it, how much you can own, what would make you add, and what would make you change your mind. You do not wait until the market is falling and then try to invent principles while your emotions are screaming at you. You need the principles before the pressure. That is why dollar cost averaging can be useful. Not because it is magic, because it prevents emotional concentration at one moment in time. It allows you to buy through volatility. It allows you to participate without pretending to be all-knowing. It allows you to convert uncertainty into a process. But even there, you have to be careful. Dollar cost averaging into a bad company is still bad investing. Dollar cost averaging with too much leverage is still dangerous. Dollar cost averaging without a thesis is just habit. The right approach is to combine a high-quality watch list with a slow accumulation system and a clear understanding of risk. The portfolio also needs a core. This is another point many individual stock investors ignore. They want to beat the market, so they abandon the market. That can be a mistake. A broad S&P 500 core can be a stabilizing foundation because many investors who try to outperform with individual stocks alone end up underperforming because they become concentrated in their own emotions. The index is not perfect. It has concentration risk. It can be dominated by mega cap names. It will fall in market crashes. But as a core, it can help prevent the portfolio from becoming a speculative collection of personal favorites. Then around that core, you can build sleeves, energy infrastructure, memory production, decision systems, cybersecurity, cloud and data, automation, financial platforms. But the foundation must be risk management, no margin. No lending against the portfolio, no debt to buy panic, no forced selling. The worst thing an investor can do is use leverage to buy volatility and then discover that time, which should have been their friend, has become their enemy. If you own a great business with no leverage and a long time horizon, volatility can give you opportunity. If you own that same business with borrowed money, volatility can force you out before the thesis has time to work. That is why I would rather move slowly and survive than move fast and be fragile. Survival comes first, then compounding, then outperformance, in that order. This is also why I do not become emotionally overwhelmed by coming shocks. The market has had wars, it has had pandemics, it has had recessions, it has had depressions, it has had crashes, it has had inflation scares, it has had oil shocks, it has had banking crises, it has had technology bubbles, and still, over long periods, the broad market has gone up because the strongest companies find ways to increase revenues, increase profits, improve productivity, and serve expanding needs. That does not mean every period is easy. It does not mean every company wins. It does not mean price does not matter. It means the investor has to separate temporary disorder from permanent impairment. Temporary disorder creates fear. Permanent impairment destroys value. You need to know the difference. This brings me to the most important principle in this entire discussion. In the long run, noise does not drive value. Revenue, margins, cash flows, and competitive position drive value. People used to argue about Palantir using every possible short-term criticism. The valuation was too high. The insiders were selling. It was too much government. It was not enough government. Competition was coming. The narrative kept changing. But the better question was simpler. What were revenues doing? What were gross margins doing? What were operating margins doing? What was net income doing? Was the business becoming stronger or weaker? If a company's revenue and margins continue moving in the right direction for years, the stock price will eventually tend to follow the business. Even if the path is violent, if the revenue and margins deteriorate, a good story will not save you. That is the difference between narrative investing and fundamental investing. Narratives move prices in the short term. Fundamentals determine the long-term outcome. This is why the Iran shock, or any shock like it, should not simply make you afraid. It should make you more disciplined. It should force you to look at your portfolio and ask hard questions. Do I own businesses that can survive a difficult macro environment? Do I own businesses tied to the bottlenecks of the next decade? Do I own too much of something that only works when money is easy and oil is cheap? Do I have enough cash flow, patience, and emotional stability to buy quality if the market sells it to me at better prices? Do I have a system, or do I only have opinions? Because the shock itself is not the whole story. The shock is the event. The response is the opportunity. Most people will respond with fear. They will wait for certainty. They will sell what they understand because the price is down, then buy what feels safe because the crowd is hiding there. The disciplined investor does something different. He watches the pressure move through the system. He studies which businesses are harmed temporarily and which are harmed permanently. He studies which bottlenecks become more valuable. He keeps a list. He buys slowly. He avoids leverage. He maintains a core. He does not confuse a red chart with a broken business. He does not confuse a green chart with a good business. He lets the market's emotional cycle serve his long-term process. The coming period may be volatile. It may be difficult. It may make the average investor feel that the world has changed too much to invest. But that is usually when the best long-term setups are created, not because fear is pleasant, because fear changes prices. And when fear changes prices faster than fundamentals change value, opportunity appears. That is the work, not predicting the exact day, not knowing the exact bottom, not shouting the loudest opinion. The work is understanding the chain of cause and effect: oil shock, inflation pressure, Fed constraint, consumer squeeze, market fear. Quality businesses sold with everything else. Long-term winners offered at better prices. That is the chain. You do not have to be reckless to benefit from it. In fact, recklessness is the thing to avoid. You need patience, you need liquidity, you need a watch list, you need a system for buying, you need a system for sizing. You need the humility to admit you do not know the bottom. You need the courage to act when the probabilities are favorable. You need the discipline to keep your eyes on the underlying business. And you need the emotional stability to remember that the market has survived more chaos than any one investor has personally lived through. The world does not stop. Companies keep trying to earn revenues and profits. Human beings keep needing energy, data, security, transportation, financial services, communication, software, hardware, and productivity. The strongest companies adapt to that need. The weakest companies disappear. Your job is to tell the difference before the crowd does. So if the Iran shock comes and oil moves higher, do not only ask what oil will do next. Ask what higher oil reveals about the system. Ask which costs rise. Ask which companies get squeezed. Ask which central bank tools become limited. Ask which businesses become more necessary because the system is stressed. Ask where the bottlenecks are. Ask where the durable winners may be forced down by temporary fear. That is the more valuable question. And when you have the answer, do not rush. Build your process, keep your core, buy slowly, avoid debt, focus on quality, watch revenues, watch margins, watch survival, because in the end, the investor who survives the crisis with a clear plan is the investor who can use the crisis. The investor who panics becomes the opportunity for someone else. I do not want to be the investor who panics. I want to be the investor who understands the machine, respects the risks, and prepares before the crowd understands what is happening. That is how you turn chaos from something that hurts you into something that can work for you, not by gambling, not by chasing, not by pretending to know the future, by studying the system, owning quality, buying with discipline, and letting time reward the businesses that truly matter.